every Monday to Friday. This is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis, welcoming you to my podcast Money Talk for Monday the 20th of May. As we kick off the new week, I have an update for you on the main business, finance and economic stories you need to know about as trading commences across Asia. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's retail sales grew at the slowest pace since 2022 in April, while industrial production accelerated, highlighting the unbalanced recovery of the world's second largest economy. Industrial production grew 6.7% year-on-year in April, beating economists' forecasts of 5.5% and 4.5% growth seen in March. However, retail sales grew only 2.3% from a year earlier, compared with analysts' forecasts of 3.7% and 3.1% growth in March. Real estate investment growth dropped to minus 9.8% year-on-year, missing consensus forecasts for the third consecutive time. Prices for new homes in first-tier cities fell 0.6% from March to cap an 11th straight month of declines and registering the fastest month-on-month fall since November 2014. 64 of the 70 medium and large cities recorded declines, rising from 59 in March. China has embarked on its most ambitious effort yet to rescue the property sector and shore up the broader economy. On Friday, the central government announced 300 billion renminbi, that's $41.5 billion in funding to help clear excess housing inventory, as well as measures to ensure developers have access to financing and to encourage the repurchase of idle land. The relending funds will enable local state-owned enterprises to buy unsold homes they can then offer as affordable housing. Ping An Insurance is weighing options that would allow it to reduce its 8% stake in HSBC. One option an internal team at the Chinese insurance giant is considering is further share sales, similar to the $50 million sale it disclosed last week, as it seeks to reduce its $13.3 billion position in Europe's largest lender. On today's programme, I'm joined by Alex Wong, Director at Alex K.Y. Wong Asset Management, and Le Shah, Asia Chief Economist at BBVA, and providing a view from Mainland China will be Shanghai-based independent economist Andy Scher. And this morning's Asia newsletter is updated and available at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks were muted on Friday, but the main indices notched a fourth straight week of gains. The Dow closed above 40,000 for the first time in its 128-year history, with the abrupt breakout happening in the very last minute of trading. The 30-stock average rose 134 points, or 1/3%, to 40,004. For the week, it was up 1.2%, its fifth straight weekly gain. The S&P 500 inched up 0.1% to 5,303 and rose 1.5% for the week. The index had rallied on Wednesday to a fresh record high after the latest monthly US inflation data showed signs of cooling. The Nasdaq Composite ended down 12 points, or 0.1%, at 16,686, but climbed 2.1% over the week. Wall Street's fear gauge, the VIX Volatility Index, slid below 12 to the lowest level since November 2019. In government bond markets, the 10-year Treasury yield added 4 basis points to 4.42%. The 2-year yield rose 3 basis points to 4.83%. And the US dollar index was down 0.8% over the week. The offshore yuan depreciated to around 7.23 renminbi per dollar, and the Japanese yen weakened slightly towards 156 yen per dollar. Gold surged to a new record closing high last week, its first close above $2,400. The precious metal rose 1.5% Friday and 2.3% over the week to $2,415 an ounce. Oil prices bounced on the week, with Brent crude oil up 0.9% at a 2-week high of $84 a barrel. For the week, it rose 1.5%. Bitcoin broke a 6-week losing streak. The cryptocurrency rose back above $67,000 to its highest in 6 weeks, gaining almost 3% Friday and almost 10% over the week. Stocks in China and Hong Kong got a boost on Friday after China's central bank announced sweeping measures to boost the slumping property market. Mainland China's CSI 300 index rose 1% Friday, marking an 8-month high. And the CSI 300 real estate index closed up 9.1%, taking its weekly gain to almost 15%. That's the most since early December 2015. Hong Kong's Hang Seng Index rose for the fourth straight week, the longest stretch of advances since January 2023. The Hang Seng Index climbed 177 points, that's 0.9%, to a more than 9-month high of 19,554, taking the week's gains to 3.1%. The Hang Seng Mainland Properties Index surged 5.3%. Shares of Logan Group jumped over 9%. Longfor Group was up almost 11%. China Vanke gained over 19%. And Sunac soared almost 26%. Looks like the rally is going to continue this morning at the Open. Futures markets pointing to a gain of about 120 points. The projected Open for the Hang Seng, 19,670. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us Alex Wong, Director of Alex K.Y. Wong Asset Management. Morning, Alex.
Good morning. Good morning, Peter.
And also with us is Shah, Asia Chief Economist from BBVA. Morning, Shah.
Morning.
Let's start with some of this economic data. First of all, China's retail sales grew at the slowest pace since 2022 in April, while industrial production accelerated. Industrial production grew 6.7% year-on-year in April. That's according to official data from the National Bureau of Statistics. Beat economists' forecasts of 5.5% and also exceeded the 4.5% growth seen in March. However, retail sales grew only 2.3% from a year earlier. That compares with analysts' forecasts of 3.7% and the 3.1% growth seen in March. The fallback reflected weaker spending on cars and home appliances, the data showed, despite a government effort to encourage people to trade in old products for new ones. Auto sales were one of the biggest drags on spending, slid 5.6% from a year earlier. That's the deepest single-month drop in almost 2 years. China's car makers, of course, are engaged in a big price war at the moment, and that could be encouraging consumers to delay purchases. Alex, what do you make of this? It seems like it's a little bit lopsided, doesn't it, this recovery at the moment, with sort of industrial production doing quite well, but retail sales, fixed asset investment disappointing.
Yeah, I think, as you point out, I think the price war actually could delay consumer purchase decisions because they know that there will be new models and the price actually will be coming down. So I think that is one track. And also I think the slower home sales actually also affect the appliances market as well. And if you look at the PPI together with the industrial production, then that is not a healthy phenomenon because with the PPI we remain under pressure. But the industrial production actually pick up. So that means the manufacturers actually are operating at a thinner margin, and I think that is not a good sign as well.
Shark, what do you make of this data?
Yes, I agree with Alex on this point. It shows that this recovery is quite unbalanced. And what makes me a little bit worried is that it seems like even we exclude the factor of these auto sectors, these retail sales, maybe they will grow by 3+%. So that means overall, the problem not only just happened to this auto sector, we have good reason to believe this auto sector will come back if they start this trade-in program. But if we look at the service sectors, they also slow down compared to the first quarter. That's not very good sign, and this property market continue to weigh on people's consumptions in home appliance, in this renovation materials, all these sort of stuffs. That overall, they shows that people's consumer confidence is still weak. They must take some measures to boost people's confidence so that they can have a more balanced recovery.
So what is it that's boosting the economy then? Because if consumers aren't really buying, investment is slowing as well. Is it mainly just manufacturing in these new areas that the Chinese government wants to promote? Is that where the growth is mainly coming from now?
Yeah, the problem is, of course, you can produce some this new, we call the new three, okay? The battery, the EVs, and also these solar panels. You can produce a lot of these things in manufacturing sector, but it seems that domestic market, they don't have that big demand to observe this one. They must look to this international, the overseas market to observe their production. For the short term, maybe that's a necessary way to help you stabilize your growth figure, but over the long run that will cause more trade conflict with other trade partners. I think United States, EU, they already initiate some kind of investigation against China. United States already imposed this tariff, right? So then it's unsustainable in the long run, right? For the short term, of course, you can export more while your consumption is very weak, but in the long run you must find a balanced way to balance your supply and the demand. You need to balance your domestic demand and this international demand.
So it sounds like really there's consumer fatigue at the moment. The services consumption, which really was boosting the retail sales, that's starting to really sort of come back to a more normal level.
Yes, I think that if you look at the service sector, it outperformed in the first 3 months, but now it seems that they tend to normalize. Okay, you cannot expect this one to always in that level. But overall, I think that in future, if you think the Chinese consumption, they will come back, you must count on these service sectors.
Alex, what's the implications of this data for investors and for the markets?
Well, I think in the meantime, we should be a little bit cautious about the current rally, I think. First of all, this is boosted by the property measures, which I think may not have a very large structural impact. And then if you look at the recovery, I think the consumer side actually is lacking strength. So I think we are already seeing some weakness in some consumer stocks already. So I think we should be a little bit cautious at current level.
It seems investors are focusing more on, rather on the weakness in the data, they're focusing more on what they think will be the stimulus measures that are going to come as a result of this. Is that right?
Yeah, right. I think right now it's a momentum trade. Actually, the rally actually is bottoming out, but they are bottoming out to those weak stocks like Alibaba and properties and insurers. So I think we need to be a little bit cautious because the best one actually are now being sold out for funding. So and then people actually are chasing laggards. So I think we should be a little bit cautious because the overall recovery picture actually is not that healthy.
What do you make, Shark, of the fixed asset investment data? Grew 4.2% year on year. That was also disappointing, wasn't it? It was below what analysts were expecting, what we saw in March, although we did see some quite good growth in infrastructure investment, up 6% year to date. But the property side really sliding, isn't it? It just seems to be no bottom there, down almost 10% year on year so far.
Yes, I think if you look at this property investment, I think the figure is quite disappointing. That means the previous measures to stimulate the property sector, I think they play some role, but it's not that effective. Okay, so that's why they step up their efforts to boost the property sector in terms of the lowering this first home and second home down payment requirement, and they also said the government they will do some purchase of the inventory in this sector. I think I agree with Alex. I think maybe market should be cautious on that one. But one good thing is that it shows the government maybe they are changing their mentality, because in the past, to some degree, they were constrained by the President Xi's statement that all this housing is for living, not for speculation. But now it seems they are willing to relax some restrictions to make this one have a little bit of speculative things. Yeah.
Well, let's dig into more detail in these property measures that were unveiled on Friday by the PBOC. It's probably the most ambitious effort yet to try and rescue the property sector. There was a series of policies unveiled. The central government is going to provide 300 billion renminbi, that's about $41.5 billion US, in funding to help clear excess housing inventory. And they've also unrolled measures to ensure developers have access to financing and buy back what they call idle land, in other words, land that's not being used by property developers. And these funds, they want local state-owned enterprises to buy unsold homes that they can then offer as affordable housing, as well as, of course, the local governments as well. Now, the PBOC says this should result in banks extending an additional 500 billion renminbi into the scheme. Also on Friday, the PBOC eased mortgage rules and scrapped the mortgage rate floor for both new and second homes nationally. The PBOC also cut the minimum down payment ratio for first home time buyers from 20% to 15%, and for second-hand homes from 30% to 25%. Now, that's the lowest rate since mortgages were introduced in 1992. Alex, let me get your thoughts, first of all, on the overall size of this. If I understand it correctly, there's about $4 trillion of inventory, property inventory in China. So is this going to be enough? $41.5 billion to buy up that inventory is about 1.3% of the overall sort of housing inventory in China. Is this going to be enough?
I think that is not enough, and that it takes years to clear the inventory. So I think the impact actually may not be too strong. Of course, it is already a very big sum of money, and that will help the market a little bit. Basically, this is the government buying. Suddenly, you got some injections from the government into the system. So that would be helping a little bit. But I don't think that the structural problem would change. First of all, the affordable housing actually will have crowding out effect on the private sector as well. And then people still know that there would be excessive inventories, especially in those second or third-tier cities. And the demographic situation actually has not changed. We are still facing with a older population, and also probably the population will be declining as well. So I think that is something not changed by these policies. So I don't think this is something structural. So this would be something helping in the short term.
Does it have any impact on sentiment? I mean, the problem has been, hasn't it, that people just don't want to buy at the moment. So I'm wondering who's going to buy these, sort of the marketable portion of this inventory? Is it going to help boost sentiment at all?
I think for the first-tier city, the sentiment is okay because people want to move in those cities to make their livings. So I think for first-tier cities, actually sentiment would be okay. But for those third or fourth-tier cities, actually they are not enough people. And if you know that there will be excessive supply, then people actually will still delay their purchases decisions.
Who is it who gets the money here? It's not clear where the money is actually going. Is it going to the banks, or is it going to local governments, or where's the money actually going to?
I think they will be going, at least they will be going to developers, and then the developers actually would be tied, and then they need to give to their respective lenders probably, or the local governments. Yeah.
Okay. So, but how can local authorities afford to do this? The problem is they're already saddled with a large amount of debt, aren't they? And now they're going to be asked to buy up or buy back what the government calls this idle land. In other words, land that's been sold to property developers but isn't being used. Can they afford to do this?
I think they probably still can, but the problem is it's not helping at all, I think. Yeah.
Shark, what do you make of this? Is this scheme, is it big enough, first of all, to make a difference?
I think in terms of this size, it's already big, but I think the most important dimension we need to measure is how fast they can deploy these kind of things, because they said, okay, we have in total 1.1 trillion and we will buy part of this 4 trillion inventory. Maybe our estimate is even higher, maybe 5 to 6 trillion inventory. So that means if you do that one in 3 years, then that's nothing, right? If you can effectively mobilize all this money to finish that one in 1 year, I think that make a big difference, right? So the number one is the time. The second one is the price. You think about this. If all this, when we talk about this inventory, we use this aggregate value, right? The 5 to 6 trillion. What about they take discount of the 50%? Then that will become 3 trillion, right? You use 1.1 trillion and you use some tricks, you can do that one. I think that one important another important dimension is the price. If this government, they want to acquire this idled land, they acquire this inventory in this property sector, at what discount they can do that one? People said maybe they will do that one at least 30% discount compared to the market price. And in that case, I think, that will complicate things, because you will see they buy very cheaply, and at the same time, all the developers, they want to maintain their market price. So I think the case is very complicated, but I think that's a good step, and that's a welcome step for many people. Even these developers, in fact, they owe a lot of the money to local government. They owe a lot of the money to other suppliers. So that means even they can get the money, I don't think they can really get the cash flow. Okay, this money to quickly transfer to other stakeholders. So that's a very interesting one. I think it's worth monitor the progress.
So we're not talking about the cost of this. The government's putting aside 300 billion renminbi. We're talking about really then what's really needed is at least $1 trillion, not 300, not $41 billion.
Okay.
So it's I suppose it's a start, isn't it? That's the key thing.
Yeah.
But Alex, does it have what's the impact on investors and on markets? Obviously, the property sector rallied on Friday on the back of this. But what's the thoughts?
I think if you look at longer term perspective, then I think it is a good chance to get out of those trouble sectors right now, because I don't think that they will have much progress in the long term. And we all know that in the new AI era, actually, they wouldn't have much benefit as well. They are not growing. So this is best. They are rebounding from heavily oversold conditions. So this is just a one-off relief rally. So I think from a longer-term perspective, actually, I would take this chance to reduce those trouble sectors exposures.
Really, right. So, and what about the rest of the market? We've seen this rally now extend even further. So far this month, I think we're up close to 10% now, aren't we, on the Hang Seng Index, and that was after a 7.4% jump in April. So we've gone from being one of the world's worst performing markets, or the world's worst performing markets, to now being one of the world's best performing stock markets this year in the space of a couple of months. Where do we go from here?
Yeah, I think we should be a little bit cautious towards the month end, at least. I think in the short term, I think we should be taking some money off the table in Hong Kong, I think, because first of all, this is boosted by the property measures news, and I don't think this is a structural news. So this is a good opportunity to offload those holdings. And secondly, I think we are seeing some weakness in several big heavyweights already. So the momentum actually is losing. So I think the best one actually are already being offloaded. So this is some cautious sign by the market already. So I would be a little bit cautious towards this month end.
So, and your four stocks in the Alex Index: HSBC, China Mobile, CNOOC, China Resources Power. Since we created this index back in September, it's up 24.3% now.
Wow.
The Hang Seng Index up 7.5% over the same period. So are you sticking with them?
Yeah, I'm sticking to value, yeah. I think probably the first three would be consolidating. And I am still quite bullish on the last edition. I think they will be China resources power actually will still be okay and outperform, because if you look at the overall sentiment in the world, actually people are chasing copper and also chasing electricity right now. So I think that will also happen in Hong Kong. I think people in Hong Kong also will be more bullish on electricity related investments.
And HSBC, of course, in the news with that report that Ping An is looking to sell its 8% stake in HSBC. Is that going to be an overhang over the stock?
Yeah, I think there will be overhang, but this overhang, I think, probably would create some buying opportunity for long-term investors. Banking stocks would be doing okay because I think the overall background macro scenario is higher for longer right now. So if you look at the overseas banking sectors, actually they are doing extremely well and resilient right now. If you look at JP Morgan, actually it's hovering above $200. So I think this one is still okay, and I don't think Ping An would dump the whole stakes. Probably they will still maintain a stakes in HSBC. So that would have less impact than the market think, I think.
So their sort of proposal to split up the bank and have an Asian-focused bank listed in Hong Kong and then the rest of the bank in London, is that really over now? Is that proposal now dead?
I think eventually they will still be like the status quo. I don't think HSBC would do this kind of split. So, but Ping An probably will still be pushing, I think.
Shark, let me ask you about the US economy, because we had quite a lot of data out last week. It seems to be showing that maybe these interest rate rises that we've been seeing over the last couple of years are starting to have an impact, aren't they? Because there's certainly a feeling that economic growth in the US is slowing. We saw that in the retail sales numbers, in the industrial production numbers, also the jobless claims, also the housing starts. Are you seeing the same thing? Are you getting a feeling maybe that now we are seeing the economy start to slow? And what sort of impact is that going to have on the Fed?
Yes, I think that now the U.S. economy, they start to slow. I think the signals are very clear. It's not surprise, because if you keep this high interest rate for a longer time, eventually, so your growth will slow down. But although I think the U.S. economies, they outperform for quite a long time. So I remember at the end of the 2022, people start to talk about this slowdown, this soft landing, hard landing. But these kind of things continue for almost 18 months, right? So even now we can see, we see some signals they are going to slow. But that's, as I said, that's maybe not normal, but that's a business cycle, right? The business cycle means you have a peak, you have a child. Maybe that the peak and the child are different. Their distance could be bigger, could be shorter than the normal one, but this time I think eventually they will have these kind of things. The impact on Fed, I think we always have this kind of the projections. This year, Fed, they are going to start this interest rate cut. Maybe for now the market they price in 1 to 2 times. So we said 2 times starting from September. So I think this is quite in line with our previous projections. It's not big surprise to us, but still the problem is even we see the economic activity to slow down, that doesn't mean inflation will slow down.
Well, that's the thing. It's not, is it? That's the problem, maybe.
Yes,
isn't it?
exactly.
While the economy is slowing, inflation is still above 3%.
Yeah, exactly. So, but that's not surprise, because sometimes the inflation could be move slower than the economic activity, than GDP figures. But overall, I think for Fed, they will focus on inflation. That's true. But also, I'm confident that when the economic activity start to slow down, eventually that will transform into the pressure on inflation. So that's why we believe that this year they will cut the interest rate.
Jamie Dimon, the CEO of JP Morgan, he was saying he was more worried about inflation than the markets were, and he said he thinks there may be significant price pressures to continue to influence the US economy. He was talking about things like costs linked to the green economy, the remilitarization taxation, infrastructure spending, trade disputes, the large fiscal deficits. He's saying basically there's a lot of inflationary forces in front of us, and the markets have underestimated that. What do you think to say to that?
One thing he didn't mention is Trump. Okay, so if Trump, even Biden, he started to impose this tariff on the Chinese imports. So that means in future, if the U.S. become more, they become more accustomed to use these trade barriers to stop something from China, or they try to protect. They become more protectionism. So then I don't think that's a good news for the inflation. So it is true that there's a lot of uncertainties that could affect the U.S. inflation, but it depends, of course. If they can make wise policies, I think, as I said, in normal business cycle, when the growth start to slow down, eventually that will transform into the inflation. But if they have a bad policy choice, it could be. So it could they have a high inflation but a lower GDP growth. So we call these kind of things like stagflation.
The dreaded S word.
It depends on the policymakers.
Alex, what do you make of US markets? The Dow now above 40,000, the S&P 500, the Nasdaq also reached new highs earlier on last week. Why is everything going up? Not just stocks, but we got almost all stocks actually, and Bitcoin, other cryptocurrencies, gold, precious metals like and industrial metals like copper. Why is everything going up?
I think first of all, the market actually does not trust the system. I think first of all, we are seeing weakness in Treasury. Actually, Treasury has been very disappointing despite weaker economic data. So people probably are worrying about the ability of the U.S. to refinance the debt. So I think the auction of the Treasury actually probably will still be disappointing, I think. So that's the market worry. So they are rushing to other investment tools like gold, Bitcoin, and even copper right now. And copper actually is benefiting from the expectations of higher investment in the electricity area. So that is helping copper. I think overall the U.S. market would be very polarized. Right now the market actually is off guard and or complacent. If you look at the implied volatility or the VIX, actually it is extremely low right now. Mm-hmm. And I think we probably may have a breakout this week because we will have the upcoming announcement from NVIDIA, and I think that would be market moving. So that I think would be the major market event this week, and probably we may see some increase in volatility later on. And then if you ask me, I think we should go with the trend towards those companies which would benefit from a sticky inflation right now. So we are seeing strength in commodities-related companies, and also higher for longer themes. So the banks probably will still be okay, but many tech stocks actually fail to move up along with the market, and also I think some traditional companies which are weaker in their respective sectors actually also not liked by the market. So I think this would be some polarized performance. But overall, I think we should be a little bit cautious because it is lacking momentum, and I think in this kind of implied volatility situation, a breakout on the downside actually would trigger some spiral.
Has the nature of the US economy changed? It seems that companies are investing more in the United States now than they have in quite a long period of time.
Yeah, right. And I think that's helping some companies. So people actually are chasing those. And if you look at the performance of the Dow, actually, it is outperforming other right now. So I think the preference of the market actually also has changed a little bit as well. So the strongest stocks actually would be the more boring one than the Magnificent Seven, I think. But anyway, I think the market as a whole may not be too bad, but we may be due for a correction, and then I think we should be quite selective in stocks.
Does this remind you a bit of the 1990s? That was probably the last time when unemployment was low and there was excitement about a new technology, which at the time was the internet, wasn't it? That was driving a frenzy then in tech stocks. Are we seeing a sort of similar thing again now?
Yeah, right. I think, but I think the market actually is changing their focus a little bit because in the last year probably they are more focusing on AI infrastructure or AI application, but now they are more focused on the need of the AI. Actually, they are more bullish on the electricity supply story right now because that is a safer one to pay, and then you don't need to care about the business model of AI right now. So you just go for the need of the AI. So I think there's a changing theme in the market right now.
Shark, the final word to you. I mean, a lot of people saying this is like a Goldilocks economy. It feels, everything is just right. Of course, you remember Goldilocks ended with the bears coming home. But what are the worries that we should think about? I mean, I'm thinking, what about government debt? It's huge, isn't it? And the interest payments on that debt are going up quite rapidly as well. Is that something to worry about, or are there other things we should be worried about?
I think that in the long run, of course, this debt issue is a very important one. But for the short term, I don't think that's a big issue because United States, they have US dollar. They dominate the world monetary system. So as long as they have the right to issue this US dollar, I think they have way to support their debt. Remember, they had a QE, right? Not many years ago, that they have a QE things. They have a lot of way to deal with this situation. But I agree with Alex on the point that I'm a little worried about this asset bubble issue for the moment. Remember, you mentioned this 1990s, but at the beginning of the 2000s, right? They have the tech bubble, right? So now we don't know whether this AI thing will become the next tech bubble or they become this internet. Yeah. I think we need to worry about this one. Okay.
Okay, well, thank you very much. You heard there Lashar, Asia Chief Economist from BBVA, Alex Wong, who's Director at Alex KY Wong Asset Management.
Talk.
I'm joined now by Shanghai-based independent economist Andy Sher. Good morning, Andy.
Good morning, Peter.
Let me ask you first of all about the economic data that came out on Friday. First of all, retail sales grew at the slowest pace since 2022, but industrial production accelerated. That was up 6.7% year on year. Retail sales grew only 2.3% year on year. What's your thoughts on the economy at the moment? Is it looking a little bit unbalanced right now?
Yeah, I think that, the economy is always a bit unbalanced. It appears that exports are having a recovery. They were flat last year, so this year looks like it's going to be 7, 8, or maybe even higher. So, but retail sales kind of been struggling for some time. Last year was about 5%. This year maybe a bit lower, but right now I assume that 2% is too low. I don't think that it's going to be this week further in the second half of the year.
And it seems that auto sales were one of the big drags on spending at the moment. Is that because of this price war? So, cars are being cut so much now that it's actually encouraging consumers to delay purchases?
Yeah, so there's a bit of that. I think also auto sales rose very strongly last year and in the first quarter, like 10% on a very high base, like 30 million units. So I think that if the market cools down, it's understandable. But there is a problem of now the auto market is behaving more and more like a mobile phone market because technology is changing very rapidly, and the battery cost is coming down very rapidly. So if you wait a little bit, you get something better for less. So there's incentive to wait.
And what about on the services side? That seems to be slowing as well, doesn't it, on the retail sales side? Presumably that's been driving a lot of the retail sales growth over the last few quarters. Is that a bit of a worry?
Yeah, the domestic tourism was very big and was driving the service sector quite a bit. And in the first quarter, it was still strong. I guess that it's cooling down a bit. The base is not so low anymore. It's 5% of GDP already. So, there's a little bit of payback in terms of growth. But I think that considering the household finances in good shape, bank deposit is very strong. So the household sector does have money to spend. So I assume that it's not going to be that bad.
And what about the fixed asset investment side? That was another disappointment, I think, there, wasn't it? We saw fixed asset investment grew 4.2%. Investment into real estate fell almost 10% year on year. It seems that the property sector remains the big drag on the economy.
Yeah, the property sector is actually cooling faster than before. The sales of new residential properties by 20% in the first 4 months. So the property sector is being hit by very rapidly declining sales. So their liquidity is running out. So obviously they have to cut back more. So it's going to be the government is introducing a bit of policy trying to slow down its decline. But I do think that the property sector looks like it's going to be weaker this year than last year, and there will be a drag on the fixed asset investment. But in terms of how big a difference it makes in reality, I'm not sure. It's a number, and it doesn't really affect people's lives that much.
Well, what do you make then of the plan that was announced on Friday to try and rescue the property sector? The central government's announced 300 billion renminbi. That's about $41.5 billion in funding to try and clear some of this excess housing inventory. They want developers, they want local governments to repurchase the idle land from developers. And then they also want local state-owned enterprises to buy some of these homes and then sell them as affordable housing. What do you make of this plan?
Well, first is that it's largely about confidence. The property market is so big. The money we're talking about is not very big. It's really about confidence. The second point is relevant is that a lot of land use needs to be changed. The property developers bought land and expecting sales to be like 2 billion square meters per year forever. It's just not going to be like that. So. Too much land. The land bank is too big, and it needs to be changed. Its use needs to be changed. So I think that there may be a little bit of money of there is beneficial to all parties involved. It's good for urban development, and it's also alleviates developers' finance a little bit. But I think overall, the amount of money we're talking about is relatively small. The land problem in small cities is unlikely to be resolved. Small cities don't have the money to pay developers, and the people are not going to buy there because they don't want to live there. So this problem is going to be with us for many years to come.
Because I've seen various estimates of what the value is of this unsold inventory. Maybe I've seen around $4 trillion, $41.5 billion, just over 1% of that amount. It seems too small to me. It seems like this is not going to make a real difference. And of course, also as you convert these properties into sort of like social housing, affordable housing, you sort of destroy the value of them even more, don't you?
Yeah, I think that the government does not have a comprehensive plan yet. It's much more about coming up with a little idea here, a little idea there. As long as it doesn't cost a lot of money, let's make an announcement. Maybe people feel better. Maybe the market will improve. That is still the strategy. I think that the right strategy is really to look at China's urban development and social problems together. Now, urban development is the issue is that the people want to live in big cities, and the price is too high. So obviously, the price is too high is because of land cost. Something you can do. So that's sort of one issue. Then you have to deal with the small cities. The governments need to be much smaller. And there should be alleviation of debt for them, but they should not be able to spend more in the future. So that part. The other part is that now the birth rate is declining because the people living in big cities and the cost of living is too high. So if you address this comprehensively, you say let's build cities just for newlywed couples, and make it very friendly for child rearing. Okay, and let's turn all these property projects that were supposed to be sold for very high price. Now let's change it. Let's change that. So Chinese government is powerful enough to do something very constructive. But right now, I think they are just muddling through because it's not important. What's important is technology, because they think the U.S. wants to bring China down, and you have to focus on technology to make China self-reliant. Then you can be safe. It's much more about a political survival, regime safety. So all these problems we're talking about will be left behind, and only when they have like a spare energy, then they'll turn around to focus on those things.
So it sounds like from what you're saying, it's not just the size of the bailouts that's too small, it's the whole approach. There needs to be a more holistic approach to this problem, which really only the central government can do, can't it? It can't really rely on local governments to do this. They've got too much debt anyway, so I'm wondering how they can afford even to buy up all this unused land.
They can't, because the local government debt is like almost about 60% of GDP. Most local governments are basically technically bust.
So that they're not going to be able to take on more debts to go and buy back all this unused land.
Yeah, the key thing is that the economic managers at this point are not incentivized to do something big. And the economy is muddling through because the top leadership's attention is on geopolitical competition. So as long as you can keep this problem under the sheet and it doesn't blow up, then you're safe, right? So no one is going to take away your job. So I think that is how to understand China's economic management at present.
Now, what do you make of the announcement last week from the Biden administration to put tariffs on various products, about $18 billion worth of imports, including electric vehicles? The tariffs are going to quadruple from 25% to 100%. Is there any impact on China of this, or is it just too small an amount?
Yeah, I think that the immediate impact is relatively small, and you're just driving more production to Vietnam, to Southeast Asia, and to be exported to the United States. But most value added still would be from China. So there's a bit of a self-deception involved, and the EV part is maybe big because that if you do open the market and the Chinese EVs could compete very, very successfully. I think what's driving this is really political, because Biden doesn't want to lose out on protectionism to Trump, because it's become very popular in the United States. I think the real significance is that the United States is withdrawing from global trade, and it set up this trading system after the Second World War, because the United States was so powerful, half of global manufacturing, global economy. And so it wanted the whole world to engage with it. And right now, the U.S. is very defensive. The U.S. industry is just not competitive. You look at the U.S. automakers, after 40 years after Japanese hit the market, they're still not competitive. There's something fundamentally wrong with the industrial management in the United States. All these guys have been just talking. So I don't think that the U.S. can solve their industrial competitiveness problem anyway. So the U.S. wants to be an industrial power. Otherwise, they cannot remain a superpower. So the only way to go about that is to protect its industry. So this is just the beginning. The U.S. will get less and less engaged in the global trade. So this is where it leaves China out there alone. China has to champion global trade, but China obviously is not such an import-oriented economy. So this is where the Chinese leadership needs to understand that. And now you want a global status, you want people to like you. You have to become more import-oriented, so that the world looks up to you when the U.S. is pulling out. So it's got a lot of opportunities and responsibilities coming China's way, and they need to rise up to the challenges.
And do you think they will retaliate against these tariffs?
There will be some retaliation because you cannot stop the United States, because the U.S. is mainly an import-oriented economy right now. They doesn't export a lot. So the point is to deter Europe from doing what the United States is doing. Europe exports tens of billions of dollars of expensive cars to China, like Porsche, like Ferrari, and China is the most important market for U.S. luxury cars, and it's very important for U.S.'s industrial base. So if Europe does that, like the U.S. impose 100% tariff on Chinese EV, China will add another 100% tariff on U.S. luxury cars. And in terms of cost-benefit analysis, it doesn't work out for Europe. So China can keep Europe engaged. Europe does not want to be a superpower. Europe does not have the natural resources to support a protected industry. It needs to get engaged in the world. So this is where China should both provide incentives and also kind of a stick on both sides to keep Europe engaged. So I think that China is gradually rising to the challenge. It must be the leader in global trade for the system to survive. And it's in China's interest for the system to survive. So you have to really grow up, not just to talk tough. You have to not just to use stick. You have to use carrots. And the China needs to become more import-oriented. In that regard, China needs to appreciate the currency. The only way to make Chinese demand grow much bigger, the currency has to rise. The China, what made in China price is too low. And it does cause imbalance in the world. You need to recognize that. So Chinese currency needs to rise substantially.
Andy, it's fascinating talking to you. Very interesting points there indeed. Thank you very much. That's Shanghai-based independent economist Andy Scher.
You're listening to Peter Lewis's Money Talk. Money Talk.
And thank you for listening this morning. Do please take a look at my daily newsletter, which has more information on some of the topics we've discussed today. You'll find that at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, David Roche, President and Global Strategist at Independent Strategy, and in Washington, D.C., our US economics correspondent, writer and broadcaster Barry Wood. See you tomorrow.
Money Talk